Let's discuss what balance of payments is and what are its components. As I mentioned in a previous video, balance of payments is simply a record of all countries' international transactions with the rest of the world over a certain period of time. This is presented in the form of double entry bookkeeping. In other words, every transaction will be recorded twice, as a debit and as a credit. The balance of payments will record all transactions between all residents of a country, which include citizens, companies, government, and the rest of the world. What you need to know is that balance of payments will consist of four main parts. It will include current account, capital account, official reserves account, and statistical discrepancy part. So what is current account? Current account will record all trades in goods and services. Plus, it will also record all income transfers and flows to and from abroad. Capital account will record transactions which are related to transfer of funds due to sale and purchases of assets and liabilities. Official reserves account, or country's reserves, will include holdings and changes on holdings of gold, foreign currency, special drawing rights, which is a special international monetary fund reserve currency, and so on. And because in order to record all these transactions, we'll need to find data from variety of sources. They will come from different sources and at different periods of time. There might be some discrepancies. So the balance will not necessarily balance. And in order to avoid this, there is a little section called statistical discrepancy, which will include all errors and omissions. This is to ensure that the actual sum of elements or components of balance of payments will add up to zero. So this is the formula which you'll need to remember for your exam. It's called balance of payments identity. This formula simply tells us that a sum of balances on each of the accounts in a balance of payments should add up to zero. So a sum of current account, capital account, reserves account, and statistical discrepancy should add up to zero. And if it doesn't, then statistical discrepancy will ensure that this will be the case. What exactly does this mean? How do we interpret this formula? This identity, this equation implies that if a country is running a trade deficit, like an example which we have covered in the previous video lesson, then it has to be covered by borrowing, because current account deficit implies that we have purchased more than what we've sold. We have spent more than what we've earned. For example, let's imagine that you've earned £100, but you have purchased goods for 150. This means that you are running a deficit in your trade with the rest of the world, which means that you will need to finance it from your savings or from your borrowing. The same is true for a country. So if a country is running a trade deficit, if this number is negative, it implies that it must be covered by surpluses on other accounts. In other words, we need to run a surplus on a capital account. Capital account will include transactions which are related to investments by foreigners in our economy. So in order to cover our trade deficit, we will need to attract investments from abroad, which will ensure that we are running capital account surplus. Alternatively, if we cannot do this, if we don't have an investment climate which is attractive for foreign investors, if we are running deficits, combined deficits on both current and capital accounts, if both these numbers are negative, it means that we will need to rely on our reserves. So if we are running combined deficits on current and capital accounts, so we are spending a lot of money, more money than we have, we are not attractive for foreign investors, so we cannot even sell our assets to cover this, because foreign investments simply imply that you sell, for example, shares of British companies to foreign investors. If we cannot sell shares to cover our trade deficits, if we are not attractive, it implies that this combined deficit will need to be covered by drawing on reserves. We will need to exhaust, we will need to use available reserves. So strictly speaking, we are relying on our savings, which we've made as a country previously in the past, which of course cannot happen continuously. If we accumulate debt all the time, we will rely on savings for a little bit, but eventually there will be a point when we use up all our savings, then there is no money left in our pockets, in our bank account, or in our country's account. And as a result, if our reserves drop to a very dangerously low limit, this can cause a crisis of confidence and so-called run on a pound. In other words, there might be financial crisis in a country. It might lead to a panic. In other words, our reserves are limited, and because of this, the deficits, trade deficits, cannot be supported in the long term. And this is one of the reasons why balancing our trade with the rest of the world, avoiding significant balance of payments deficits, which we cannot cover by attracting foreign investment, is one of the objectives of macroeconomic policy. We try to avoid excessive exchange rate fluctuations, and we can achieve this. One of the ways of achieving this is avoiding significant trade deficits.